So today we're going to be looking at the duality concept, and in particular page 34 of this booklet, exercise 15. And going to page 3, the first page in this booklet, it talks about the duality concept just here. The equation also reflects the duality concept, which is that every transaction must have at least two effects on the equation to ensure it remains equal at all times. And of course, we're talking about the accounting equation, which is assets equals liabilities plus equity. And if we turn that around, equity is equal to assets minus liabilities. So let's have a look at page 34 now. And this exercise, exercise 15, is called the transaction effect. I like to say that every transaction has an equal and opposite reaction. And let's have a look at this one that I've created earlier. So here is our accounting equation, assets equals liabilities plus equity. And over here we've got equity equals assets minus liabilities. That's also known as our net assets, our equity, our capital balance from the statement of changes in equity. It's called our residual interest, our net worth. All these terms are interchangeable for E, for equity. And it's very important because there is an equal sign here. It's an equation. It's balanced. What is on the left-hand side of the equation equals is balanced with what's on the right-hand side of the equation. And so we cannot change one side of the equation without also changing something else, either something on the other side of the equation or something in the opposite direction on the same side of the equation. Let's have a look at what we mean by this. So here we have an example. The transaction here says the owner puts money to start the business. So he's putting money into his business. He's contributing money. And the two assets that are going to be affected by this transaction are the cash account and the owner's capital account. The cash account is an asset account, of course, and by putting money into the business, the cash account is increased. And at the same time, if the asset account is increased, the equity account has to also increase because the owner has contributed equity into the business. And so we write down here cash, an asset, increases. And also capital, an equity account, also increases. And over here we display it with the accounting equation A equals L plus E, and we write an arrow up here next to the A and an arrow up here next to the E. That sounds easy enough. So let's have a look at this next transaction. Purchase inventory for cash. So what are the two transactions, what are the two accounts that are going to be affected here? Well, of course, it's the inventory account and the cash account. So if we pay for something, if we purchase something for cash, cash is going out, cash is decreasing. Our cash account will decrease. And we're purchasing inventory. So our inventory increases. And of course, these are both asset accounts. So if you have a look at the effect here, the cash account, which is an asset account, decreases, and inventory, which is also an asset account, increases. So we have this both down and up effect on assets on the one side of the equation, and our equation is maintained. The integrity of the equation is kept. Just like above here, if assets increases and equity is affected, equity has to be increased by the same amount. You can have compound and complex scenarios where you can have the asset here can be funded by part liability and part equity. You can do that. But we're just going to look at more simple transactions here where there are only two accounts affected. So what you need to do in this exercise is keep working through this exercise. Let's have a look at the blank one. Purchase inventory on credit. So here we had purchase inventory for cash. Inventory went up, cash went down. And the next one is purchase inventory on credit. So an asset, inventory, is affected and so is the credit. So work your way through these. There are a couple of tricky ones, so look out for those. Have some fun, and we'll see you on the other side.